As of the closing bell on Friday, November 28th, Opendoor Technologies Inc. is trading at $7.70. We are looking at a daily decline of 8 cents, or roughly 1.03%. If you are watching the after-hours tape, the slide has continued incrementally, dropping another 2 cents to $7.68, a further 0.26% dip. When you look at a 1% drop on a Friday, it is easy to dismiss it as standard market noise or end-of-week profit-taking. You might glance at your Schwab Intelligent Portfolios dashboard, see the red tick, and move on. But to dismiss this specific movement for Opendoor at this specific moment in time would be a mistake. The expectation for Opendoor right now, fueled by a resurgence of retail meme energy and complex financial engineering, is that the company is on the verge of a massive breakout, a short squeeze that will punish the skeptics and validate the believers. The reality, however, is that we are witnessing a company fighting for its life by radically altering its capital structure and business model in real time. That $7.70 price tag is not just a valuation, it is the battle line between a potential tech turnaround and a slow drift into irrelevance. Let's dig into the immediate price action because it tells a story of exhaustion. The stock has been on a roller coaster ride throughout late 2025, driven less by selling houses and more by the mechanics of the market itself. Today's drop, while small in percentage terms, comes on the heels of the company's aggressive move to distribute tradable warrants to shareholders. When a company issues a special dividend, usually it is cash. Opendoor, however, issued warrants, essentially options to buy stock at higher prices in the future. The expectation from the retail crowd, especially those active on Robinhood stock trading forums, was that this would ignite a buying frenzy. The theory was that short sellers, who are heavily positioned against Opendoor, would be forced to cover their positions to avoid the headache of dealing with these new warrant instruments. But the reality we are seeing on the chart today is that the squeeze has not materialized in the way many hoped. Instead of a vertical launch, we are seeing a slow bleed. This suggests that the market is digesting this financial engineering and asking, okay, but do you actually make money selling houses? To understand why this stock is trading at $7 and not $20 or $2, you have to look at the volume and the players involved. The volume today was consistent but not explosive. This indicates that the institutional giants, the ones managing Fidelity mutual funds or Vanguard allocations, are largely sitting on their hands. They're looking at this warrant structure and the recent capital light pivot with a high degree of skepticism. When you see a stock dominated by retail flow, which Opendoor often is, the price action becomes jittery. It reacts to headlines and sentiment rather than earnings beats. If you're using the Interactive Brokers trading platform, you can likely see the order flow is fragmented, lots of small lots, indicating that the smart money is not yet stepping in to support this level. They are waiting to see if the new strategy works before they risk their capital. We need to address the elephant in the room, the business model pivot. For years, Opendoor was a simple, albeit capital-intensive business. They used debt to buy homes, fixed them up slightly, and sold them. It was flipping at scale. The problem, as we all saw in 2022 and 2023, is that when home prices stop going up every month, this model implodes. You end up holding billions of dollars of depreciating assets. The expectation now is that Opendoor is transforming into a platform, a marketplace where buyers and sellers meet, and Opendoor takes a fee without taking the risk of owning the home. This is the capital light strategy. It sounds fantastic. It sounds like becoming the Airbnb or Uber of real estate. But the reality is that building a marketplace is incredibly difficult when you don't control the inventory. The stock is struggling to gain traction because investors are not yet convinced that this pivot is anything more than a survival tactic. They're asking, if you aren't buying the house, why does the seller need you? This brings us to the leadership. The recent appointment of Kaz Nejatian as CEO is a clear signal of this shift. Nejatian comes from Shopify. He is a tech guy, not a real estate guy. The narrative expectation is that he will bring tech efficiency to a clunky industry. He will automate the processes, use AI to price homes, and turn Opendoor into a software company. Investors love software companies because they have high margins and scalability. Think Nvidia stock or Microsoft. Real estate companies have low margins and high headaches. The reality, however, is that you cannot code your way out of a foundation repair or a leaky roof. Real estate is inherently physical. The friction on the stock price right now is the market's doubt about whether a Silicon Valley approach can truly solve the muddy, messy problems of buying and selling physical homes in a high-interest rate environment. Speaking of the environment, we cannot ignore the macro headwinds. The housing market in late 2025 is in a deep freeze. Interest rates, while off their peaks, are still high enough to create a lock-in effect. Homeowners who have a 3% mortgage are not selling to buy a new house at a 6 or 7% rate. This means inventory is historically low. For a company like Opendoor that relies on transaction volume, this is a disaster. It's like running a stock exchange with no stocks. The drop to $7.70 reflects this stagnation. While Fidelity wealth management analysts might argue that the demographic demand for housing is strong, the transactional reality is weak. People are staying put. If people don't move, Opendoor doesn't make money. Let's talk about the specific financial instrument that has everyone talking, the warrants. The Series K, the Series A, and the Series Z warrants. This was a move straight out of a financial engineering textbook. By giving these to shareholders, Opendoor effectively tried to weaponize its own equity against the short sellers. If you are short a stock and a dividend is paid, you are responsible for paying that dividend. By making the dividend a complex warrant, it creates a logistical nightmare for shorts. This is why you saw the stock pop a few weeks ago. It was short covering. But now that the dust has settled, we are back to fundamentals. The reality of a warrant is that it dilutes the stock if the price goes up. It puts a ceiling on the stock because if the price hits the strike price, new shares are created flooding the market. So while it was a clever move to punish shorts in the short term, it has created a long-term overhang on the stock structure that might be keeping new investors away. I want to pause here and engage with you on this specific point, because it is rare to see a company do this. Comment below if you received the Opendoor warrants in your account. Did you sell them immediately, or are you holding them as a lottery ticket? I am very curious to see how the retail base is handling these complex instruments. Now, let's look at the meme aspect. Opendoor has found itself in the same basket as other high short interest names. This is both a blessing and a curse. The blessing is liquidity. When the Robinhood crowd gets excited, volume spikes and the price can disconnect from reality, offering great trading opportunities. The curse is volatility and lack of credibility. Serious long-term investors, the kind who use SoFi Invest for their retirement or build portfolios with Schwab, tend to avoid meme stocks. They view them as gambling. For Opendoor to sustain a price above $10, it needs to graduate from the meme class and enter the growth compounder class. To do that, it needs to show a path to profitability that doesn't rely on accounting tricks or one-time benefits. The Q3 2025 earnings report was a stark reminder of how far they have to go. They missed expectations. Revenue was down. The contribution margin, a key metric that measures the profit on each home, is still under pressure. When you look at the financials, you see a company that is shrinking to survive. They are buying fewer homes, operating in fewer markets, and cutting staff. This is the right thing to do to stop the bleeding, but it kills the growth narrative. You cannot trade at a tech multiple if you are shrinking. This cognitive dissonance is what keeps the stock trapped in this $7 range. The bulls are pricing in the future platform, the bears are pricing in the current shrinkage. If we look at the competition, the landscape is shifting. Traditional brokerages are adopting tech. Zillow is still the 800-pound gorilla in the room, with its massive traffic advantage. If Opendoor wants to be a marketplace, it has to compete with Zillow, not just coexist with it. Zillow has the eyeballs, Opendoor has the transaction engine. Can they bridge that gap? That is the billion-dollar question. If you are analyzing this stock using Fidelity ETFs or sector funds, you will notice that real estate tech as a sector has been beaten down. Opendoor is not alone in its struggle, but it is unique in its capital intensity. Let's discuss the risk of the death spiral. This is the nightmare scenario for any company that relies on debt facilities to fund operations. Opendoor uses massive credit lines to buy